In this short video, we will discuss currency risk. Our discussion will touch on the currency market, its history, types of currency instruments, how risk is generated, and why currencies fluctuate. Currency risk can be thought of as the exposure a portfolio manager has to one currency relative to another. This risk can be created by speculation in the market known as the foreign exchange market, or by receiving profits or capital in a currency that is not your home currency. The currency market is the largest and most liquid of the capital markets, with over $4 trillion per day changing hands. The market is active 6 days a week, nearly 24 hours a day. Trade flow is dominated by the money center banks, large financial institutions, as well as funds. The modern foreign exchange market began in the early 1970s when countries began to switch to a floating rate exchange mechanism from a fixed rate regime. Prior to this period, countries fixed their currencies to other countries' currencies and did not let them float per market sentiment. The Bretton Woods Agreement established the financial and commercial relations between major industrial countries. These countries that participate agreed that they would allow their currencies to float in the marketplace. The currency markets are vast, but the majority of the capital flow comes through the major currency pairs which trade against the US dollar. These pairs include currencies from the UK, the EU, Japan, Switzerland, Australia, and Canada. In addition to major currency pairs, there are also cross-currency pairs, which do not include the US dollar as a counter currency, as well as there are emerging market currency pairs. Currency instruments are traded on an institutional as well as retail level. Large currency transactions usually dominate the interbank market, which is large money center and investment banks who dominate the capital flow. Many hedge funds use banks as their market makers for currency transactions as the bid-offer spread is relatively tight. In addition to the over-the-counter interbank market, investors can access currency markets through the regulated futures exchanges. These exchanges offer futures on currency pairs, but are limited on the number of cross currencies that are available. There are also a number of retail currency brokers who offer a plethora of currency pairs to clients with relatively solid market-making capabilities. The majority of the transactions that take place in the Forex market are spot transactions, which settle 2 days from the date of the transaction. Other types of transactions that take place in the currency markets include forward transactions as well as options transactions. A forward transactions occur when the settlement date is beyond the normal 2-day spot settlement period. In this case, the short-term interest rate differentials between the two countries are used to determine the forward points, which are either added or subtracted to the spot rate to create a forward rate. The options market is liquid and sophisticated and offers a range of products from standard European settlement to exotic, complex structures. Risk in the currency markets are usually initiated by speculation on the relative direction of one currency versus another, or generated from profits in the foreign currency market that need to be exchanged for a home currency. Profits can come in the form of invested income or capital from portfolios that are invested in instruments that are not denominated in the portfolio manager's home currency. Profits can also be operating income that is generated overseas and needs to be converted to the home currency. When an investor speculates in the currency market, he is speculating on the relative value of one currency toward another. This is accomplished by purchasing or selling a currency pair. For example, if an investor purchases the currency pair euro versus the US dollar, they are speculating on the relative value of the euro versus the dollar. If the euro-dollar currency pair rises, the euro increases relative to the US dollar, and the investor will benefit as the number of the dollars it will take to purchase 1 euro will increase. If the currency pair euro-US dollar falls, the investor will lose income as the number of dollars it takes to purchase 1 euro will increase. The currency markets are one of the most highly leveraged capital markets. Leverage in both the retail and the institutional level can reach levels near 100 to 1. This means that for every dollar risk by an investor, $99 can be borrowed for investing in a currency pair. With leverage this high, an investor's capital can be wiped out with just a 1% move in the currency pair. Risk in the currency markets stem from a change in the underlying exchange rate to changes in the actual forward rate. As mentioned earlier, the forward rate is the interest rate differential between the home currency and the counter currency. A change in the interest rate differential between these two countries will have an effect on the currency pair exchange rate. Currencies move based on the supply and demand for an individual currency pair, similar to other capital markets. Most market pundits monitor the economic data points globally to determine if capital flows will move into or out of a specific currency. This type of reasoning is called fundamental analysis and can be absorbed by monitoring global events on a daily basis. Additionally, following the specifics of monetary policy is vital to a currency movement and can be altered when central banks change their stance on interest rates. The currency markets are the most liquid in the world, and generally the risks associated with these markets are systematic risks, meaning they are market risks. For many of the emerging market currencies, investors can face liquidity risk, which means getting in is a lot easier than getting out. The leverage associated with these markets create a substantial risk to investors which are not aware of the pitfalls of gearing and leverage. Investors should be cognizant of all the risks of a market prior to entering them, and the risks in the currency markets because of leverage and the short-term volatility can be substantial.